I'm Mark Jones, the head of content at Charity Digital. I'll be your host for today and like to give you all a warm welcome. Please do introduce yourselves in the chat and let us know where you're joining from. Today's session is on preparing the new Charities SORP and we'll explore key changes and the practical implications. It's delivered by Matt Jones, partner at accountancy firm Burgess Hodgson, and Connor Harney, senior manager at Burgess Hodgson. In the session, we're likely to learn the level of reporting required under the new regulations, the impacts on figures within financial statements, the basics of the new trustee report requirements, some best practice advice, and a lot more. In terms of house rules, the session is being recorded and will be uploaded to watch on demand within a week's time. We will, of course, share any resources and the slides, so don't worry if you miss anything or anything goes a bit fast, we can recap there. Closed captions are available, so all you need to do is in the button at the bottom of the Zoom window, click the up arrow button next to closed captions, and then click closed captions, and show subtitles. Let us know if you have any issues with that, and we'll help. During the webinar, and this is super important, please ask as many questions as you like in the Q&A section down there, and just keep asking throughout the session, and we'll get to them at the end. Well, I say we, Matt and Connor will. And so, yeah, you can see that on the bar, and you can upvote any questions that are relevant to you. So it's a super helpful little function. So there's an arrow that you can upvote. So any question that you'd like to see answered, we can make sure that's answered first by giving that an upvote. Finally, any sound or image issues, let us know, and we'll do our very best to get the session back on track. However, we need to do that. That's all from me. Please, again, do ask questions. And I'm going to hand over to, I think, Matt. Are you going to kick us off?
Yes. Yeah. Thanks very much, Ewan. Hi all. So yeah, as introduced, I'm Matt Jones, partner at Burgess Hodgson. So a little quick background about what we do. So we are an accountancy firm based in the southeast, so mainly Kent and London, but providing services all over the country. We deal with a wide variety of CIOs, charitable organisations, your standard charitable trusts, providing accounting and audited services mainly, but we provide payroll, management accounts, and just general support to try and make the accounting for all of you as easy as possible. So yeah, personally, I've been working in the charity sector for 12 years now, through accounts, audit, etc. And then again, on the personal side, running a sports club myself and sort of supporting other local charities. And I'm joined today by Connor.
Hello everyone. Thank you for giving us the opportunity to present today. So as Matt says, I'm Connor Harney, I'm senior manager at Burgess Hodgson. I haven't been there quite 12 years. I've only made 9 so far. But yeah, I've worked charity throughout my time here at Burgess Hodgson, and also a trustee at a local citizens advice bureau in my area. So yeah, looking forward to present to you today.
Perfect. So yeah, just a very quick overview of what we're going to be running through today. So to start with, we'll be going over the new income thresholds that are coming in under the SORP, to give an overview of what level of reporting you should be expecting with the upcoming changes. Connor is then going to go through the key changes as far as the accounting side, the main bits being the leases and income. And then we will round up with the changes coming to the trustee report, and summarising the new requirements within there. So, brief introduction. I'm sure none of you need it, to the new Charities SORP 2026. So there's been a long and painful public consultation process for the new SORP, and a couple of the key objectives there listed, which have been mentioned beyond throughout that process. The main factors driving the change are to maintain consistency with FRS 102, which is changing across all companies from January 2026, and the desire for stakeholders or users of charity reports to get a better understanding of what charities that they are dealing with do. And then finally, to try and shift to a more proportionate accounting regime, and provide more support or less burden for smaller charities, on the understanding that quite often it's trustees or people giving up their time as well as a full job, to try and ease the burden of the time that they are giving up there. So in summarising these changes as well, what we hope to do is give you some takeaways and objectives of what you can be doing in your next trustee meetings, or for the finance professionals, what you should be discussing in your teams, so that there's sort of some clear action points that you can take away and start to get ready for the SORP. So the new SORP has a 3-tier reporting system. As mentioned, this will come into effect for reporting periods starting on or after 1st of January 2026. So I think for most of you, that will be the 31st of December 26 year end, or later will be the first accounting period for which you'll fall into these. So as far as the SORP reporting, there is a 3-tier system determined on income. So Tier 1 charities are those with income up to 500,000, Tier 2 from £500,000 to £15 million, and Tier 3 for larger charities with income over £15 million. And how the tiered reporting system works is the SORP is broken down in certain modules, with Tier 1 requirements, which all charities above the pyramid have to abide by, and then those only relevant to Tier 2 and 3, and then finally the Tier 3 top level ones that only the large charities have to deal with. So as far as the modules affected within the SORP, most of these still, all of the treatment will be the same for all charities. So the what we would call the body of the accounts, quite a lot of the figures in there and the accounting policies are going to be the same still, no matter the size of the charity. But the key modules here, where there are tiered requirements that differ depending on the size, are Module 1, the Trustees Annual Report, which, as mentioned, we'll come to at the end, the key changes in there and how those differ between the tiers. Module 4, 8 and 9 I'll group together quickly as far as the statement of financial activities. Tier 1 charities have the option there of the natural classification or activity basis. So natural classification is more your classic company accounts, where it's broken down by wages, gas, light, heat, rent, on that sort of basis. That option isn't available to Tier 2 and 3 charities, so income over 500,000 have to do the activity basis of reporting, which is based on the charitable activities and breaking down costs between fundraising, charitable activities, governance, etc., which I'm sure you're all fully aware of from previous SORPs anyway. So there's a slight reduction in the burden on smaller charities there, which don't necessarily have opt to that, but I think it's still best practice where possible for the users to apply the activity basis, as it does clearly give a good indication of how the charity is using the money for the charitable purposes. And then the final one, the statement of cash flows. This now is only necessary for Tier 3, so the large charities with income over £15 million. So previously this has been a requirement for a lot of smaller charities. That's no longer there. Of course, for management decisions, for the trustees' benefit, they may still want to see a cash flow, statement and also cash flow budgets. But as far as putting that there within the financial statements, that's now only a requirement for Tier 3. At the same, not nearly the same time, we've also had changes coming in or likely to come in for the auditing and independent examination requirements for charities. So this, confusingly, a slightly different date, is for accounting years ending on or after 30th of September 2026. So there may be any of you with October or November year ends may have a strange overlap period where this will apply, these regulations will apply, but the new SORP won't quite have come into effect. So this has been to align the independent examination and auditing requirements more in line with well, with the inflation, they haven't been updated in so long that it's to bring them in line with proportionality of the charities compared to where you would have been 10 years ago with the same thresholds. So the key ones there being we've got independent examinations are now only required where income exceeds £40,000. What that doesn't take away is for those with income over £25,000, it is still necessary for accounts to be filed at the Charity Commission. These won't need to be examined by an assurance provider, but there is still the need for them to be filed alongside the annual return. The option to prepare receipts and payments accounts has been increased now. So if your income is under £500,000, you can follow the receipts and payments accounting standards, most likely with the natural classification basis, I would expect in that situation. Income over £500,000 is now where you need an independent examiner with a or a chartered accountant, we would call from ICAW, ACCA, or any of the accountancy bodies. And then the audit threshold has now increased to income over 1.5 million or over 500,000 where assets are over 5 million. And then that's the gross assets for the charity there. They were discussing as well as part of this changing how the thresholds are applied as far as income to try and take out one-off legacies pushing charities straight into the audit thresholds. Unfortunately, that hasn't or doesn't look like it's going to be applied. So this is still a treatment on a year-by-year basis rather than aligning with Companies Act where it looks if you meet the criteria for 2 consecutive years. So this is just a summary table, really, giving a quick basis of where your income is, what you are likely to need to do across your accounts, what level of independent examination or audit or assurance requirements you need, and what tier of the new Charities SORP 2026 you'll be following. Just a caveat, this is solely the charity side of the regulations. Any charitable companies will also need to take consideration of company law thresholds and the other regulations there. So, as I said, these slides will be shared so you can keep a note of this. But I will now pass on to Connor.
To meet your volume.
Yeah, of course.
Yeah, so thank you, Matt. I think it's just so hopefully the echo goes once Matt turns his volume off. Yeah, so hopefully that's better. Obviously let us know if not, and we can have another look. So as Matt mentioned, there's all these changes that I'm going to mention, both leases and income recognition, come into effect from the 1st of January 2026. So that'll be your starting year ends from the 30th of September 26. So kind of the big change with leases is kind of around the kind of operating lease side of things. So obviously previously or currently these operating leases will be recognised in your kind of SOFA as the expenses incurred. But going forwards, the SORP kind of changed that, kind of in line with what's happening in IFRS or IFRS 102, should I say, to recognise a right of use asset. I've got a couple of examples that will hopefully help understand that a bit better. But effectively, what happens is that we'll recognise an asset that would depreciate over the term of the lease, and we'll have a corresponding liability on the balance sheet too. And the liability will have to bring into kind of present value. Again, as an example we run through, and then that will actually incur interest at the given interest rate over the term of the lease. So this will affect leases that are longer than 12 months. Example of these being a 3-year car lease or kind of a 5-year office lease. And there are a couple of exemptions. So the first one being short-term leases, and these are the ones less than 12 months. You've got your leases that are basically come to an end during the transition period, so there's no need to kind of go back and change them. And we've got our low value items. So the SORP doesn't actually give us a value of a low value item, but it's your kind of like your laptops, your phones, kind of the smaller leases you might have. We won't have to make the changes for them. There is we'll see on the first slide, there is a helpful flowchart that's been included within the SORP that helps you understand if it is a lease, and it kind of helps you give these exemptions. You'll see it in the next slide, but it helps you understand if these exemptions are in place or if you need to account for the new changes. And finally, there is a scenario with peppercorn rent and social leases that we'll run through in a couple of examples. So this is the flow chart that I mentioned. So ours has got a bit more colour, but the one in the SORP isn't as colourful. But as Matt said, that the slides will be shared, so hopefully you can use this as a resource going forwards. Effectively, you'll start on the left-hand side, same as any flow chart. I don't need to tell you how to use this, but you'll follow it through using the different questions, and you'll kind of get to a solution, whether the lease is needed and a right of use asset needs to be recognised, or it falls into one of them exemption categories. So I'll leave that with you, the flow chart, to kind of run through your own leases and make your own decisions there. So on our next slide, so this is just a quick recap of what would be the costs that go into that right of use asset. So it's fairly straightforward, hopefully. So obviously you'll have your lease liability amounts and any kind of incidental costs that you have incurred at the start of it. So they'll also go into your asset on the balance sheet. The only part of this that probably doesn't look as you don't recognise, should I say, is that value of the social donation. And this is for your leases that are where you might have a terms in place that's less than market value. So what we do is, if it's less than market value, that kind of difference is shown as a donation, with the other side going into your right of use asset to be depreciated over the term of the lease. So on the next slide, that's all right. So I've included, so these examples actually are in the SORP, but they're a bit wordy. So I've tried to make it a little bit more easy to understand here. So for this example, simple case, a charity has entered into agreement to use one floor of a 5-storey office for 3 years. So the market rent per floor in this case is 120,000, but as part of the lessor's corporate social responsibility, they've given us a 50% discount. So we're only paying 60,000. If we were to go and try and rent an equivalent space elsewhere, we would have to pay £72,000. So in this scenario, the difference between that equivalent space and what we actually pay is your non-exchange component, and that's your kind of the social donation. So we know in this scenario, because it's a 60k lease, it's probably not peppercorn, it's a considerable amount. So a lease is in place, but we'll have to recognise that 12k as the non-exchange component. So the entry there would be debit your assets to increase your asset value, but at the same time you'll show a donation on your SOFA for that 12k income. So that's the social donation. Obviously there's probably a little bit more to it. It's not always leases as simple as that, but hopefully that gives you kind of a little bit of an insight of how we deal with that bit. And then on the next slide, it's the same scenario, but in this one we only pay a peppercorn rent, so we're only paying that £10 a year. So in this case, the non-exchange component with that 71,990, but because of the exemptions that you can see on the flow chart previously, it wouldn't actually define a lease. So we wouldn't have to recognise it as a lease in the balance sheet, but what we would do is recognise that right of use asset and depreciate that over the term of the lease as well. So that double entry there would be you debit your assets and you credit your social donation of the 71,000. And next slide, that's right, Matt. So obviously there's leases that we're already going to have in place. So we're going to have to make sure, so there are provisions in place to how we deal with that. We'll see later for income recognition, there's kind of 2 different options, but certainly for leases, we only have one option provided. And in this case, this will be for your, we'll use the retrospective approach. So effectively work out what the liability and what the asset would be as if we always have that lease in place. And then we'd make any differences that we have, we'd make an adjustment to our opening reserves rather than go back and change any previous posted accounts. So that means obviously your comparative information won't need to be changed in this scenario. It's obviously a lot easier, as you'll see later with income recognition. There's another option, but I'll run through shortly. Here's the next slide, that's right. So this is a brief example of how the transition would work. So in this case, a charity has 3 years remaining on the lease. Each year they pay 10,000, and we've assumed discount rate here of 5%. The discount rate is a difficult part. I think it might be something you work with your accountants here. So there might be 2 ways you might work it. So the first one might be your incremental borrowing rate, and this is the interest rate you would incur if you were to borrow funds on a similar asset, or it might be you might use the obtainable borrowing rate, and this is the rate you would get if you had to go and get a comparable kind of a loan for the same amount. In this scenario, obviously, we've just chosen 5% for simplicity. So we've got 3 years left. So there's again, use the slides after, run through it yourself, but there's a little present value calculation there to understand what the present value of that 30k is currently. And initially, we'd recognise a right of use asset of 27,233, and the corresponding entry would go into your lease liability. And then at the end of each financial year, you would obviously recognise a little bit of interest into that liability. We'd pay out 10,000, and that would clear down over the course of the 3 years. And the right of use asset would be depreciated over the 3 year of the lease. Same way, any other asset would be depreciated, really. Yes, that's the next slide, please, man. So yeah, what should you do now in terms of leases? So I think the first step would be definitely to understand what leases you've got in place, because there might be documentation you need to ask for. So making a list of, okay, what leases could potentially be relevant to us, and obviously use that flow chart to help you understand that. And once you've kind of got the ones that you know, yeah, this will affect us going forwards, we're trying to understand the present value of that lease commitment, because once we've got that, we should know what the right of use asset amount will be. And I think that's quite an important point, really, because the right of use asset will obviously increase our gross assets, and that kind of leads on to leads off from the point Matt said earlier to do with the audit thresholds. Obviously, we're increasing our gross assets here, so it could be that if you're bound by Companies Act, it could actually push you over the edge into that audit territory. So it's important to understand as early as possible what the impact of your charity is actually going to be. And lastly, with leases, I would say obviously you want to communicate with your trustees as early as possible, because there'll be changes to the presentation of the account. So obviously, we want to manage expectations there. And any questions, obviously, engage with your accountants or your auditors as early as possible, just to help both sides, really, help you understand a bit more, hopefully. Obviously, that was only a brief overview, but there's a little bit more to it. But hopefully, that kind of gives you a little bit of an insight of what the leases and right of use assets will look like in the coming years of your financial statements. So yeah, moving on now to the changes in income recognition. So the main change, to summarise it here, so the main changes is to bring kind of the SORP, is kind of bring it similar in line with how we account for income in FRS 102. So this is income will no longer be recognised simply when cash is received or invoiced. Instead, it will be recognised as services are delivered and performance obligations are satisfied. So this means when you might have a contract that spans over a period of time, you might now have deferred income. Obviously, there might have been scenarios where we're using that already, but certainly the SORP is kind of brushed up and a bit more clear distinction of when we're using that deferred income and how that service should be used. So I've got a couple of examples again, hopefully simple ones that kind of run through each point. And the SORP is a lot more on the exchange versus non-exchange transactions. There's a couple of slides I've got will define that a bit more, but it kind of brushes up and kind of gives you a bit more clarity on what each one is. That'll be on the next slide shortly. There's also a 5-step revenue recognition model that's now included. So that helps you understand how you should, first of all, what your income stream is, and then how it should be recognised within your financial statements. And lastly, as I touched on there, the use of contract liabilities, which is effectively your deferred income. But hopefully the example should make it a little bit more clear. So next slide. So this is just a quick overview, mainly from a company's perspective rather than a charity's perspective. For charities, it's this non-exchange and exchange component, which we'll see on the next slide, but just a little overview of the difference between a contract and a grant. And on the next slide, you've got that. So this is in a charity perspective, which is your exchange and your non-exchange transactions. So for your exchange contract transactions, it will be with a third party, and it will be your services that are under contract, and you've got to provide a kind of a service to actually get this income. There's a few examples at the bottom in terms of your contracts, membership subscriptions, royalties, and it could be like your corporate sponsorship as well. Your non-exchange transactions, which we saw a little bit earlier with the non-exchange components, this is the amount that is kind of given freely without a kind of equal return from the charity. So they can have performance-related conditions, but mainly this is your donations and your grants for governments and investment income and bits like that. And so on the next slide, Matt, we've got the 5-step recognition model that is included in the SORP now. And again, with kind of the flow chart earlier from the leases, obviously use these slides to your advantage, really. Hopefully it should be fairly straightforward in terms of the steps you need to take. The example shortly will show you that. But basically, step 1 would be identify the contracts there. Your step 2 is identifying that there is a performance obligation for you to provide. Step 3 will be to determine your transaction price. Then step 4 is allocate that price to the obligation. So you might have a number of things and say, okay, it's 10,000, but you want to allocate. We've got 5 things to do, so we're 2,000 each. And then step 5 will be recognise your revenue when that performance is satisfied. So next slide. So this is example 1. So this is, again, a simple example just to kind of show you what it means. And hopefully it shows you that it is a bit more in line with what FRS 102 it means that company, the way they account for things. So in this scenario, a charity has signed a contract with a local council to run a weekly after-school tutoring session for 12 weeks, receiving 12,000. So previously, we might just recognise that 12,000 straight away in our income, and then maybe it might have been restricted and released over time. But the new SORP would say, okay, let's defer it all initially and recognise £1,000 each time each week, because we're doing 12 weeks here. Each week you'll recognise £1,000 of that income. Obviously, it could be months or however that contract's laid out, but obviously different contracts have different terms. So this is just a simple way to show that bit. And then example 2, Matt. So this is the difference between your exchange and your non-exchange transactions. So in this scenario, a charity sells tickets for a charity gala dinner for £50 each. And the income is recognised when the dinner occurs, because that's when the service and the obligation has been in return for the payment. A non-exchange transaction would be a charity receiving 5,000 as kind of a grant from a foundation with no direct kind of obligation and service to be provided back. So we'd normally recognise that amount straight away in our income, in our SOFA, sorry. And then example 3, which is to do with a 5-step recognition model. So a charity has signed a £10,000 contract with a community centre to provide 5 community workshops. So we can use this 5-step model to kind of pull out the bits of that scenario and kind of fit it in. So step 1, identify the contract. So we know we've got a contract with a community centre, that's our third party. Step 2, identify the performance obligations. So in this case, we know we've got 5 different community workshops to put on. Step 3, determine a price. We've got £10,000 there. Step 4, allocate the price. So we know we have 5 different workshops, £10,000, £2,000 per workshop. And then step 5 will be, okay, we've done the service, we've done one of the workshops, let's recognise £2,000 within our income there. That's effectively how that revenue recognition model works. And then finally, on example 4, is kind of the use of the deferred income, the contract liability. So in this case, we've been paid £6,000 up front for 6 months of mentoring. So as each month passes, we release £1,000 out of that deferred income liability. So initial recognition would be kind of you showing it into the bank, and the credit entry will sit in your balance sheet, and then we're released £1,000 each month out of that balance sheet entry into our income statement, or into our SOFA, sorry. So that's the examples there. So these are the transitional provisions. So the modified approach is similar to what we said with the leases. So this is, we go back as if we've always had this income recognition models in place, and we adjust the figures in the current year, but there's no actual changes to comparative figures. There is the option in this case to go back and change everything. So you'd go back each year and change the numbers, but obviously it's a lot more work. And our suggestions, I think, if we were giving advice to a client, would probably be to use that modified approach to recognise the income initially. Again, so what should you do now? Similar to leases, I'd make a list of all the contracts we currently have in place, and there might be information we need to get from different third parties, and then set a database up for all of this information, so it's there ready when your account prep is in place. We've got it there ready to pass on for anyone that might ask. And for each one, to kind of use that 5-step model. Have we had a service obligation? Have we recognised that? Do we need to make any adjustments there? And compare that to what we've currently done effectively, and that will tell us if their adjustments are needed. And again, finally, obviously discuss with your trustees to manage their expectations, and discuss with your accountant / auditor for any for help, because obviously they'll have to be on top of this, so they'll have to be able to advise any questions you've got, hopefully. And then the next step. So I just want to touch base. Obviously, it's maybe a little more niche, but certainly a change for heritage assets. So just a heritage asset obviously is a kind of a historical asset, or something that's held not for kind of commercial reasons, it's for protection really. And there was a couple of sentences in the SORP previously that they've changed basically from a should to a must. So the first one is heritage assets that have been acquired through a donation or another form of exchange transaction must now be recognised as fair value. And this is as much as a fair value as we can reasonably achieve, because it's not always easy. And number two, we must disclose the reconciliation between kind of open balances and closing balance. So it's more of a disclosure note within one of the accounts for these heritage assets. And then lastly, Matt touched on it briefly earlier, or lastly for me, is that cash flows. So only tier 3 charities will now actually have to include a cash flow within their financial statements. However, if you are obviously registered as a company as well, obviously the Companies Act will always override this. So you might be a medium company. So therefore, even if you're a tier 3 charity, if you're a medium company, you'll still have to include that cash flow. You can't use one exemption to bypass the other. Companies Act will always override. And there's just a quick summary there of what that medium company criteria is there, which you can use later. Obviously, won't know until the end of the year, but obviously that's it's there for your reference. So I think I'll pass you back to Matt now. We'll run through the reporting bits.
Great, thanks, Connor. So onto the changes then in the trustee report. So I think thought to start here would probably easiest really to cover the blurb that we were given by the Charities SORP as to what they were looking to achieve here, really, for the trustee report. So the primary purpose within that, as per the SORP, is to ensure that the charity is publicly accountable to its stakeholders for the stewardship of the funds it holds. So I would think from that, a key thought that we should be having immediately before even considering anything else within the trustee report is, who is your charity publicly accountable to? Who are those stakeholders referred to within the SORP that they are looking to get some useful information to? So we have a few listed within there. Again, all of these would have been involved within the consultation process. So funders or donors who are supporting charities obviously would like to see where their money or services provided are given. Service users who are actually enjoying some of the provisions of the charities may want to see what other support the charities offer. Employees and volunteers likewise, and members, all likely to be closely aligned with the charity and look to see the difference that it's making. And then the local communities to see the difference that the charities are making. So within that, the SORP mentions 3 key things really which the report should clarify beyond the financial figures, which is here listed down as the outputs. So by outputs we mean really the activities that the charity is performing. So however that may be through what services they are giving to the community, or what that charitable objective is, and how the charity performs to meet that objective. The outcomes are effectively the outcomes of these outputs, so that the outcome to these activities, how to show the performance against what the charity has said it was done, and probably here give more quantitative data as far as these are the number of sessions we've performed, or these are the number of people that we have helped within here, to give clear, measurable outcomes of the charity's actions. And likewise, there, the impact. So this is listed down as the difference it has made to the stakeholders and community. I think within this, the community is probably a word that's fallen into the SORP even more. So again, there we will come on to impact reporting, and how you make it clear within the report exactly what the charity is doing and how that is the benefit to the various users of the charity. So, might be a slide missing there, but never mind. So before going into the sort of detail on those, there's some key overriding principles which are mentioned throughout all of the different headings. I'll try and keep us on a heading basis as to the headings you'll likely have in your own trustee reports as far as the changes. But the key points mentioned throughout and pervasive really to a good trustee report are now the consistency with the figures within the financial statements. So part of this is within the activity basis. If you're in a tier 2 and 3 or a tier 1 charity choosing the activity basis, then there is now a must requirement within the trustee report that the figures reported in the trustee report are consistent with what the financial figures are showing. So I think there's just a wish really for the users of the accounts to make them more understandable, the clearer linking to the figures that are being reported. And then this consideration, again, already mentioned, to ensure that the trustees are providing the stakeholders with a clear, true, and fair position of what is happening beyond just those financials, and just providing that additional information that the set of accounts wouldn't be picking up. And I should probably touch there. I know I mentioned must and should in those sentences, but as with the old SORP, these requirements are split into 3 different headings. So there are the must requirements, which are mandatory, which a charity must be. You'd be not in compliance with the SORP if a must requirement was not included within the trustee report. The should requirements are then those which are strongly recommended as good practice that the trustee board and the charity should be ensuring are given reference within the report. And then the may requirements, which are more discretionary. Again, these would be sort of the best practice ones, and particularly if you have a specific charity where these may be really of particular relevance, still very well worth including. But if these aren't there, then there's no issues there as far as compliance with the SORP. So now we will move into the key areas or key headings within the trustee report with particular changes. So starting with the objectives and activities, all tiers must now explain the scale and nature of activities undertaken by volunteers. So as part of the consultation, I think some were pushing even for further than this, as far as the impact of volunteers on charities is not necessarily reflected in the set of accounts, due to the difficulty of measuring the time that is given by volunteers or the services received from volunteers, meaning that it's not able to recognise those within the figures within the accounts. So to get around that, this is now a must requirement for all tiers of the reporting to include some reference to activities by volunteers. We then go to tiers 2 and 3, so those with over £500,000 income have additional requirements surrounding they should detail the number of volunteers and may provide the number of volunteer hours. And I think there that should and may probably providing where it is easier for the charity to be able to obtain that information and provide the data. But the actual point here being this isn't something that necessarily you will have had to have report on. So as you're possibly starting the year where this new SORP will be in place, then please do make sure you've got systems, whether that's timesheets for volunteers or someone they're reporting to provide feedback on what they're doing for the day, so that you are able to report this in the annual report. The activities, again, and a new must requirement for all tiers is explaining the outputs, those activities that the charity is completing. Again, this goes further for tiers 2 and 3, whereas tier 1 will just be more a summary of these outputs and activities. Tiers 2 and 3 will provide more detail of these in relation to the short and longer terms objectives for the charity. Part of this is ensuring that reference to those short-term aims and how those will help reach those longer-term aims, I think, is also included within the SORP. And part of this, again, is making sure that these are measurable against something that the charity will monitor. So it should be in the tier 2 and 3 section. There should be detail of how the charity is measuring the success of these activities to ensure that there is sort of the value for money in what is being performed. So again, there ensuring that the mid to long term plans for the charity through the trustee meetings to discuss the direction, if that is nice and robust and it's clear within that how the performance against these budgets or plans will be measured, then this will really feed back here into the reporting, and it will allow you to pick from those meetings, those discussions, to put through a really good report. So the next, we're on to achievements and performance, and I think this one is probably the broadest new requirement within the new SORP, which is the impact reporting. So within here is, well, I will start with the SORP definition there for you to all see. This has been defined as the difference a charity's work has made to the circumstances of its beneficiaries, and if practicable, any wider benefits to society as a whole. So this is really looking back to those stakeholders, the key ones here being those service users, showing what you are doing for the users of the charity and reporting that to all of those who are providing the funds so they can see exactly how the funds they are donating or granting are being used. And as I said, I think this is sort of the broadest area where the trustee input is going to be the most important. The SORP does include several prompts within there, including prompts to say looking through as far as in what way has the charity's work made a difference to the circumstances of its beneficiaries is within the tier 1 SORP requirements. So that's more a summary there for how you are helping those beneficiaries. Into tier 2 and 3, there are further requirements looking again at how you are measuring or indicating how these activities are performing. So if you've set goals again, how have you performed against what you were expecting from this activity, how many people you were expecting to turn up or receive the benefit of what the charity is doing, and measure more against the expectations of the trustee beyond just providing a summary of what you're doing. And at this point, I've also sort of added in or linked in the plans for future periods, which I think normally comes later in the recommended order of the trustee report, but I think it sits really closely in here with the impact reporting and the output reporting from the previous slide, where I think having a really clear, robust plan for the charity in place is really going to help generate this reporting within the trustee report. So where the decisions are made surrounding the reasons that you're using funds for particular activities and the benefits that you're expecting the wider community to receive from those decisions will be held in trustee meetings or discussions with donors. And what we're really looking at here is setting those plans in stone, saying, okay, we are expecting this benefit to the community, and then looking back and measuring against these. So that the action suggested here is really look through these plans, look at what the charity is planning to achieve, the objectives and how it's going to meet those, quantify these goals and targets for the plan over the next 3 to 5 to however many years. And if these goals are made specific and measurable, or I've nicked the first two part of the SMART sort of goal making there, then that will allow the reporting can just be pulled from monitoring of these and saying, well, we've put this on, we've hit our targets, we haven't done it, or we haven't hit our targets, but here's how we're going to push to make sure we've got the maximum benefit to the community. So on to the financial review, which is obviously the more enjoyable bit for me as an accountant. We've got the reserves definition. So this was probably slated the most in the SORP as the poorest area of the reporting. I think partly because the term wasn't well defined previously. So to try and patch that up, the SORP now does provide a clearer definition of reserves as the part of a charity's funds that is freely available to spend on any of the charity's purposes. So on the simplest terms, what you are really looking at here is starting from the unrestricted funds for the charity. You would have to deduct anything that is not readily available for expenditure. So within this, we've got fixed assets being the buildings or the equipment you're using to provide the activities that the charity offers. You clearly can't get rid of those to be used. Any investments held or any spending committed to other projects that has already been used up with those would not be included within freely available reserves at year end. And then if within those investments there are any, or within other funds, there are any items which will become available for spending, such as in endowments where the actual capital part of the endowment is readily available for spending, these can be added in, and that will give the total reserves figure. I'm just conscious of time, there are a couple of other bits within the SORP, but they are set out there for consideration. But the key bit here is this reconciliation and how you're coming to your total reserves now must be included for all tiers to explain the reserves figure provided in the financial review. And then a key takeaway there is consider your current reserves policies, as if this is likely to change how you are calculating reserves, you would want to take a look at this before you get to the next year end, as this might impact some of the policy decisions made by management to make sure you're meeting your reserves policy. As again, there is also now further requirements that the total reserves figure should be related to the reserves policy of, I know the standard one we see lots is we hold 3 or 6 months worth of expenditure. You should be relating that policy there back to the total reserves figure and explaining if there are any differences and how it will be rectified. So then into the higher level or more in-depth requirements under the financial review, we have the risks and uncertainties. So for tiers 2 and 3 only, again over that 500,000 threshold, there are now additional issues which you should be looking to discuss. So running through here quickly, the environmental issues. How is the charity aware and addressing any environmental issues? I mean, is there any recycling schemes? Are you ensuring the LED light bulbs, etc.? I'm sure there's plenty of examples and training available to trustees or staff to keep them aware of environmental issues and what they should be doing in whatever setting they're in, if it's an office, shop, or however they are completing the work. And then cyber risk and uncertainties. How is the charity addressing cybercrime, either targeting financial gain through incenting bank details or disruption, for example, like we saw with Land Rover a couple of months ago, where their systems were completely overtaken and they were locked out of them. So again, probably here some quick wins on password protections, ensuring training. I know there's plenty of resources out there to look at and which will give those sort of quick and easy wins, which will help awareness for trustees and staff and help you to draft policies. And then finally on to sustainability from those, we've got mainly really here a tier 3 requirement, which again, just really for awareness of you. This is quite detailed here for the tier 3, where they now must include a review of sustainability considerations and allow plenty of time to draft, as this is quite an in-depth piece of work that will need to be done on all tiers, really. You're looking at, if you do hold investments, you must have a policy within there to explain how you have your ethical considerations around those investments. And you may include anything on the sustainability side for other matters as you see fit to provide useful information to the stakeholders. And then finally, going concern, there's now a requirement at all tiers to make sure there is a policy, even if where hopefully the charity is performing well and there are no material uncertainties. This does need to be included within the accounting policies section. If that isn't the case, or if there are uncertainties, there are now additional requirements where there must be an explanation where there are no reserves or negative net assets, or as I mentioned earlier, the reserves not falling within those policies. Right, I think we've tried to rattle through that as quickly as we could. I'm conscious of the time there and the questions flooding in. But yeah, if I pass back over to you.
Thanks so much. It was, thorough, and there is a lot of questions. Just to mention, everyone, if we don't get around to your questions, there is some resources that we'll share that should answer some of them on Charity Digital's website. And we try and get through as many as we can in sort of 7 to 10 minutes. Again, reminder, upvote, because there's I think there's like 27 questions or something like that. So upvote the ones you want to hear, because we'll get to those ones and we might have to swerve some of the later ones. I'll start with Rosie's question. It's been upvoted various times. Not quite clear on the exchange versus non-exchange transactions. Most of our grant applications say what we are asking for the money, e.g. deliver 50 sessions of mentoring. Does that make all grants exchange transactions?
So a lot of it, not necessarily is the quick answer. To be fully yes. It obviously depends on the kind of conditions around that grant. A lot of it is just to do with whether are they using the charity to basically outsource their own work? Are we providing something on behalf of the funder, or have we been given this money and we're kind of doing the service on top of it, of what we already do? So if there's something they can have a claw back and something, it might be that it's an exchange contract. But if you're going to have the money anyway, but there are things you're doing, it could be a non-exchange component. A lot of it, and that sounds a bit of a cop out, but it is dependent on the terms and conditions of that grant. and it might be a bit of a deeper, more discussion to have a look and see what's in each one effectively to understand what the right answer is there. That's okay.
Thanks so much. Jan Jones, again, upvoted 7 times. Are you able to share any examples or models of trustee reports under the new arrangements, or to provide a link to such models? Now, if not, if you are, we can do it and we can share it afterwards, maybe.
We don't have one. I think that this was aimed as a discussion point. I think the problem we always find with template reports is they don't necessarily fit in exactly with each charity. I mean, we certainly have we have our own policies as far as, for example, cyber risk and bits, and it is sort of the classics. I think you will find sort of most sort of data out there will give you, make sure your passwords are protected. What firewalls have you got, or just those? There are lots of easy wins out there, and that will probably be able to provide sort of a nice boilerplate policy. But yeah, we don't offer. We would be happy to have a discussion with you to help prepare a relevant trustee report, but we sort of don't believe that a template one is useful, as I think it's just I appreciate the wish to be compliant, but we do think it is something, or it almost gets around the point of what the SORP is trying to set here.
Well, we'll try and have a look at resources and send what we have to Jan and everyone else, not just Jan. Rosie's got another one that's upvoting. Well done, Rosie. Are trustees included in the definition of volunteers?
That's a good question, actually. I haven't spotted that within there. I would expect they are, on the basis that we're really looking at just taking the reason of why the SORP's putting it in there is to understand the support given to the charity that isn't really reflected within the financial figures. So I think that is of use to understand the time that the trustees are giving up. It might be a separate disclosure, sort of, we're having X number of meetings a year to make these discussions. We're sort of attending all these events. Then I certainly can see that adding value to the users of the accounts to understand, the time that's being put in to run this by the trustees. So yeah, I think that's certainly worth inclusion.
Brilliant. Beatrice asked for the tier income, which are right at the beginning, I believe. Is it to do with the income of the year in question or the previous year? They're saying their charity hovers below and above 500k depending on the year, if that helpful context.
Yes, so it will be the year. So for example, December 2026, it will be income up to that year.
Cool.
And that's where I was mentioning, I think ideally there should be an extra year built in, because that can lead you getting to sort of January 2027 and only discovering then that you've got these requirements. But unfortunately, that is the current rule. It's been raised at consultation before, and I'm hoping it's something they look at. I know it's something that ICAEW are pushing for to change the rules on that one.
Cool. Brilliant. Thanks again. Peter is asking, impact reporting, is that relevant to all tiers?
It is, yes. The tier 1 reporting is softer touch. I think that's where we're looking more at a summary of the activities. Tier 2 and 3 is where you get into the measurements of how you're performing against what you're expecting those activities to provide. So I think, yes, every tier will have to include within there brief summary of what the charity is doing, but it will be lighter touch at tier 1.
Brilliant. Jan's question, and Jan, to mention, we'll try and find something relevant for you there. Jan's question is, are there any affordable accountancy software packages available which are designed to meet the requirements of the new SORP?
As far as I'd ask for a explanation on the question. So accounting software for the charity as a whole, or for these particular changes?
I think Jan may right, but I think it's kind of saying software that kind of is particularly useful for these changes.
I mean,
or maybe not.
I think all of them will be able to do it. It's an understanding of how to use them, I think, is the issue. So we tend to work closely with Charities on Zero, where you can make these adjustments within there, either as journal entries for your transitional sort of that point in time where you need to put a transitional adjustment at the start of your year. And then you would be able to set up what we'd call sort of monthly journals. If you've got a piece of sort of that lease going in, you could set your journals for the next 12 months and put them as repeating each month. And I know that I say zero just because we use it the most, but every sort of your classic bookkeeping softwares would have that capability. There won't be anything in particular holding your hand to show you this is exactly how to do sort of the charity level adjustments. I think that would be more a conversation with your accountant or accounts team. But I think there should be sort of capabilities in all accounting softwares to meet them.
Cool. Do you have time for there's a question. I'm not sure if it repeats what we mentioned earlier. If do you have a few extra minutes?
Yeah, of course, yes.
Yeah.
Still happy to fly through them.
Yeah, are grants viewed as non-exchange transactions so we can recognize the income on date of receipt, even if they have performance requirements?
Yeah.
Yeah, so again, it kind of ties down to the conditions of the grant. So there could be, like I said, some of the grants will have conditions against it, so it still will be, although it will still have to be deferred and recognised over the course of that grant. It doesn't always necessarily say that non-exchange is this and exchange is this. It is always depending on that in particular grant and what then the terms say. Unfortunately, so like I said, we'd be more than happy to help with that in terms of understanding it. But as a blanket, yeah, this is this answer and this is this answer. It probably doesn't exist that way, unfortunately.
I think just adding on that, I think it's probably a key point, really, as I know it's a question that's come out several times now. When these grants are being prepared, is looking through the agreements and consider, is there something in here about performance and sort of, is there something in these that is having an unintended impact on income recognition now? So are there previous grant contracts you use? It's all driven really by the contracts and understanding those in line with the requirements, but maybe a review of those to make sure it has the intended consequence as far as your revenue recognition would be useful.
Brilliant. Thank you so much. I am going to wrap it up there, but just to let everyone know, they will get the slides because there's a couple of questions there. And we will, at Charity Digital, review the questions that we didn't get to, feedback on them, and we will also try and find some resources that are useful. Feel free to get in touch with Burgess Hodgson if you want to follow up on that stuff. You know, I'm sure they'd be welcome to hear from you. We haven't, just to say the final points is we have an AI summit coming up on the 12th of March. So please join us with that. We'll put the link in there. If you could share your feedback with us, that would be fantastic. There should be a link that my colleague has just shared in the chat. And that is all. So just to say thank you so much to Connor and Matt for their, really insightful, so much engagement. A lot of people obviously trying to get through this and work it all out, and you provided a huge service to them. So thank you so much for that. And yeah, thank you everyone for joining us, and we'll see you next time. Cheers.
Thanks all.
Thank you.